Hello traders, this is CarFX from Day Trading Tanzania. It's been a while right now, but I'm back again now. So in this video, it's a quick video, so I'm just going to be very brief on what I'm going to talk about. So I'm simply going to talk about the relationship between bid and ask. And also I'm just going to talk about liquidity provision. Who provides the liquidity in the market, who benefits from it, and how the process is going. So it's just a quick video. So some of you guys have the footprint chart, some of you don't, so it's okay, but some of you understand the footprints a bit in the way that you do. So I have the DOM over here, the depth of market, which shows the limit orders that have been placed in the market when the price goes up, and we have limit orders when price goes down. So these are limit buy orders which are going to be hit if the market comes down, and these are limit sell orders that are going to be hit when the market goes up. So simply, this is the bid, this is the ask. But we have another a different thing on the footprints. We can't actually see these orders in the footprint charts. You see, we can't see this in the footprint. So why can't we see this? Because the footprints only shows us the aggressive buyers and aggressive sellers, the active market participants that are entering the market at the current moment. So sometimes, for example, we have 320 lots over here traded on the ask, because on the footprint we have the bid on the left and the ask at the right. So if we have 320 lots, then price failed to go upside, rather than we just see it traded just 2 price points higher and we have sellers losing interest. No, sorry, we have buyers losing interest. So we just call this sequential decline. You see the last traded lots from the 320 going above, we have only few lots. Let me put this in a clear way. You see we have 320, 45, then 2. This is a sequential decline. We are declining going upwards. You see, another one, we can just see it over here. It's just a trade signal that you can use in a day trading print charts, and you can understand. So we have the 119, 111, and 30. This is a sequential decline. We have another one over here. You see, we have 204, 42, and 8. You just see the market was just losing strength that is going up. But it can be confusing because you can also see over here, we have 349, 21, then 7. We also have a sequential decline to go up. So when you just come here, take a look at this market, we are probably in a range bound. I don't know how long this is going to be, how long it's going to take making this move. But as you can see, we were just coming at the market close at that hour. It was late in the night at GMT +3. Excuse my handwriting. So let's just make it simple. So for us to know if we are having aggressive buyers or sellers in the market, so aggressive sellers are going to be hitting the bid. So where is the bid now? This is the bid. They are hitting the bid. It means if we have more sellers that are going to overpower these 3 lots, then price is going to drop 1 price point lower to come and trade over here. If we have 5 contracts more, we're then going to try to move down over here. Then after that, we are just going to move down over here. So you can say probably it's just supply and demand. So though these things sound a little bit complicated, but it's not complicated anyway. So if we have aggressive buyers, it means they are hitting the ask. Now we are hitting the ask. So if we have aggressive buyers hitting 9 lots, then we are gonna move and trade higher. We have other people trade more than 7 lots, we're gonna trade higher. So this is how probably how liquidity is being provided in the market. So now, why do I say liquidity is being provided in the market? Because these people, these limit orders are the ones providing us the money, are the ones providing the balance, the supply and demand, the market. Because remember, in any market, there has to be a buyer and a seller in any market. Also, we have to have time, we have to have price, we have to have location. Now, in terms of location, it doesn't mean it's necessarily has to be a physical location. It can be online over the counter, you see. So this is just to show you, to remind you. I know you probably know how the market works in sort of that way. So this is just a simple way for you to understand. So always remember that these are the active market participants driving the market up and down. These are the ones who are moving price up and down. That's in terms of limit. That's in terms of aggressive buyers and sellers. So the footprint is only supposed to show you the current prices that are being filled into the market, the active buyers and the active sellers, and shows you also the difference between active buyers, the volumes traded between active buyers and active sellers. You see, we have the maximum delta, minimum delta, and so forth and so forth. So now let's go to the why do I say liquidity provision? So now the market is closed, so we can actually see the limit orders, the big limit orders. We only see the ones that are remaining. Some of them have been pulled out of the market, some of them are still there. So now let's take away the DOM. Let's take out the DOM and let's see the footprints. So I'm just going to show you a small concept. Let's compress this in a way. Okay, let's take this price point over here. For example, this was, I think this was, this was after NFP. GBP was just rising and rising and rising. We have the point of control dominated by sellers, a lot of sellers, you see. So let's start from here. We have, from here you can just see the delta is just crazy, man. Let me just show you this for you. You see, we have delta is crazy, delta is crazy. You see, delta is crazy. So why do I say delta is crazy? Because most of the footprints analysts look at delta to determine where price is gonna go, but delta doesn't seem necessarily mean that price is gonna go down. Delta just shows you the current market participants, that we have more sellers than buyers, and it is true. We had more sellers than buyers, and the footprint shows you. But what don't you see? You don't see the limit orders. So if we had the DOM at this time, I'm pretty sure, because I was trading this day and I was very looking forward at my limit orders, footprint charts to understand more, and I was trading this day. So what did I see? What I actually saw is we had some limit orders that were acting as support. They were supporting price. Yes, we had sellers coming into the market. Okay, let me just use some of my tools over here. So, for example, here while looking at the footprint, we can just simply say that this is absorption. We have 1, 2, 3 candles, 4 candles trying to sell. Why do I say sell? Because you see, the bar is dominated by red. It's all red, man. It's all red, all red. But price is not really going anywhere. So you can say maybe it's witchcraft, but no, it's not witchcraft. It's because we have limit orders sitting over here. They are all absorbing the supply. So absorbing the supply, absorbing the supply. And when the supply was over, price just rallies up. You see, we have just small reliefs, then rallies up but up again. Because why do we have only small reliefs? Because as we are going, people are adding